Hello, everybody. This is John Graham with the Legacy Group at Keller Williams Realty here again. I wanted to say hi to everybody and wish everybody well. I hope everybody is staying safe in today's times. Today, we're going to talk about a question that I've been getting a lot lately, or we've been getting a lot lately, and that is, what's going to happen in the real estate market? So what we're going to talk about today, everybody, is a question we've been getting a lot lately, and that's what's going to happen in our real estate market moving forward. Is that big crash coming again like we had back in the late 2000s? Or are things going to stay steady? Are they going to grow? And there's some things that we'll talk about today that I think will shed some light for you. So the first thing that's different is inventory, the number of houses that are on the market for people to purchase right now. And right now, it's very low. We have a very limited inventory. As a matter of fact, we have 1.6 months of inventory, which is low. That's a neutral market in today's society. A neutral market where it's good for the buyer, good for the seller, it's kind of equal, is about 6 months of inventory. So having 1.6 months means seller's market all the way. Now, the second thing that's different is back in the crash, mortgages were easy to come by. People were literally getting loans on what we call stated income, which is, hey, I make X, trust me, and there's no verification of that. After the crash, a lot more regulations were put in around lending, and so everything is a lot tighter. There's a lot more qualified buyers. So to get a mortgage now, it's way more qualified buyers than it was back then. So there's not as much risk and flood of unqualified buyers or people that couldn't maintain those mortgages. And now the third thing is rental prices. Back then, rental prices were a lot lower than the price of a mortgage. And so because interest rates have dropped so much and rentals are now in such high demand, it's kind of shifted. The cost to rent is almost about the same as a mortgage. So that thought of being able to just walk away from your home and get a similar place to rent for cheaper isn't there anymore. And then the fourth thing is interest rates. Back then, interest rates were a couple points, 2-3 points higher than what they are right now. Interest rates currently are around 3%, which is historically low. So people have a lot more buying power than they would have back then. So lots of things going on that are different than that crash. So we would think, again, our opinion would be that the market would stay strong and it would continue to hold those home values. Homes would continue to appreciate, and it would be a great time for people to sell. And then at the same time, buying is a great time as well because you have more affordability. Because interest rates are so low, you can buy more of a house. So those are some of the differences between that crash from before and where we're at now. And I hope that helps you guys out. If you guys want to talk a little bit more about that or have some specific questions, please call us or reach out to us. Be happy to discuss that with you. Or if you'd just like to know a little bit more about your house value, we'd love to share that with you as well. So we hope everybody's staying safe, and we look forward to talking to you guys soon.